Welcome, everyone. My name is Ana Galvão, and I'm here chairing this first panel session in the ESCoE conference. So before I give the voice to the panelists, I want to show you some slides that give you the motivation for the discussion. So let me share this. So what you see first in front of you is some figures from some recent publications from the ONS. So what you have here is the following. Actually, the best thing we have is to read this headline here. Real GDP fell by 20.4% in Q2 2020. So what this time series describe is the fact that the measure of aggregate output in the UK economy that normally grows over time, as you can see here from say 2010 until 2019, had a big drop in 2020 as computed by the ONS. Other thing that happens too is that if instead of using that number I showed you before, which is the real GDP index, you could get the growth rates, which is the changes over quarter. So if you look at the period, say from 2005 until now, you can see that these growth rates are normally positive. It's hard to see them here because of the scale, and in some cases it's negative, like in 2008, 2009, and in particular in the last two quarters in which you have this drop rate of almost about 20%. There is some other data that have been published by the Office for Financial Statistics recently, in particular publication of a monthly GDP, which is a measure of GDP that's observed every month. So for monthly GDP last week was published the estimate for July. And then here you kind of see more or less the same picture as in the previous one. So you have, GDP normally grows over time on average, and then you see this big drop in more recent period. You can see a bit of a drop here in 2008, 2009. And interesting enough, as this data was published, there was this warning here that I copied from the website that says GDP estimates are subject to more uncertainty than usual as a result of the challenges faced estimating GDP in the current conditions. So this is basically food for thought for the panelists. And the last thing I want to contribute in terms of food for thought for the panelists is showing to you two definitions of recessions. So the first one is a definition normally used by the National Bureau of Economic Research, which is a kind of a research center in the United States that has a very long tradition of something that's called business cycle analysis. And what they say is that recessions are a significant decline in economic activity, spreading across the economy, lasting for more than 2 months. This is the kind of definition that sometimes is mainly textbooks in economics. And then the second one here looks quite similar, but it has some differences. So this one I just Google search from the online dictionary this morning. So recession is a period of temporary economic decline. So it looks the same as before, but during which trade and industrial activity are reduced. And then it has additional phrase here saying generally identified by a fall in GDP in 2 successive quarters. So this is the additional part that was not in the previous definition I showed you before. So I think this kind of gives a context for this panel. So the questions of this panel were proposed by Fitzner, which is the panel organizer, and the title you have there, Recessions in Real Time, Lessons from the Pandemic. And the question is, is this recession different? When you consider that you have a recession, you just observe a very large decline in economic activity, you would say you have a recession. Which kind of real-time indicators you should use to track the cycle, and which kind of indicators policymakers should respond to. So these are the questions set for the panel. Now I'm happy to introduce to you the panel members. So we have Gemma Tetlow from the Institute for Government. We have Giles from the Financial Times, Sumit Dey-Chowdhury from the ONS, Fitzner from the ONS. So they're going to talk in this order. Each one of them is going to talk for about 7 minutes. And then at the end of the talk, we're going to see if they're going to debate with each other, but more important, people in the audience can ask questions for the panelists by typing them in the Q&A box. And then at the end of the talks, I'm going to collect these questions, and actually I can ask you to unmute the microphone, and then you can ask the panelists directly. Okay, so please add your questions to the Q&A box. So I think I'm going to now stop sharing my screen so you can see all of us. And I'm going to give the floor to Gemma to address the questions I just talked about.
Great, thank you very much, Anna. So obviously this is an economic statistics conference, but I will probably focus most of my remarks on what policymakers have been caring about during this recession, because I think one of the big reasons that we care about defining and understanding the extent to which the economy is in recession is because that is a big part of understanding what's the appropriate policy response for both monetary and fiscal policymakers in setting their response to any recession. So Anna set out the kind of standard definition of recessions as being 2 consecutive quarters of negative growth. And I think this time really is quite importantly different. And I mean, to take one of the questions that we were posed, should we define 1 quarter of very large negative economic growth as a recession, even though normally we would wait for 2? That obviously slightly depends on how you want to define a recession. If we are using that definition to understand, has the economy taken a big hit? Is there a lot of spare capacity in the economy? Is there potentially a role for fiscal and monetary policy to try and cushion that blow? Then I think undoubtedly the economy took a huge 1 quarter hit this year, and quibbling about whether or not you get 2 consecutive quarters seems to me to be the wrong argument to be having. My sort of reflection on why we have that 2 quarter definition in the standard definition is that normally what we would want to do is weed out those situations where growth just marginally bobbles below 0. So you want to have 2 consecutive quarters as sort of indication that this really was a period of negative economic growth, rather than just a 1 quarter blip that in otherwise fairly flat or moderately growing growth. I think the kind of hit the UK economy took in the 2nd quarter of this year was so large, it's undeniable that that was a big economic contraction. I guess we can have a debate about the word recession and what exactly that needs to be used to refer to. Other ways in which I think this recession, if it is indeed one, is different, that it's perhaps worth thinking about, and thinking therefore about what that means for the data and how the government might have responded to it. Normally recessions would reflect sort of a shortfall of demand in the economy, and typically that would result in sort of fairly broad-based economic weakness. I think this recession is different for 2 reasons. The economic contraction was largely the result of active government decisions to shut down large parts of the economy, which is unusual, although there obviously was some element of people voluntarily cutting back on their demand in response to the risk that they faced by going out and engaging with the economy because of COVID. But I think that therefore means that perhaps some of the more macro indicators that we might look at are less informative than they might otherwise be, because the macro picture was very much a constrained response of the private sector. They were not able to do the things that they otherwise would have wanted to do had it not been for the constraints that the government was placing on them. And the impact across the economy was very heterogeneous in many ways. Some sectors could continue working quite effectively from home, whilst others really were very much shut down as a result of the crisis. So for that reason, I think it's been interesting in this crisis to look more closely at the micro data that has become available, and I'll say a bit more about that in a second. But the other feature of this crisis that was quite different was how big and fast moving it was, and therefore the potential role for government policy action to have a huge impact in determining the extent of the impact. And we've seen the government do some quite big things that cushioned the blow for the private sector, and probably did have a huge influence on whether the immediate economic contraction translated into lots of business failures and job losses or not. And the answer so far has been not. And so because of that size and the fast-moving nature of it, I think the real-time data has been much more important this time than I think it probably has been in previous recessions, where the economic hit has perhaps played out a little bit less quickly, although others may not agree with that. So thinking about the microdata then, why do I think microdata has been more important this time than perhaps normally it would have been? Partly that is, I think, to help policymakers to understand which parts of the economy are most in need of help, so which sectors have been most affected, which sectors have been able to keep going more effectively despite the requirement to work from home and social distance. And you can see that sort of use of microdata playing out in the government's policy response, I think. Looking from the outside, we've seen the government tweak policies like business loan support schemes, things like introducing the self-employment income support scheme, extending the furlough scheme, and introducing new things like bounce back loans, which were all sort of policy tweaks that happened in response to evidence that there were certain types of businesses or certain types of individuals who were falling through the gaps of existing policy support or were particularly affected by the crisis. And I think you can see sort of government using timely data as we look more into the sort of recovery policies as well. So things like the Eat Out to Help Out scheme looks like a response to the fact that even though restrictions had been lifted on people's ability to go to restaurants, the evidence was that people weren't returning to eat out as quickly as the government had hoped. And so that sort of policy was a sort of quick response to try and encourage people to go back into restaurants. Looking, I guess, very much as an outsider to some of what's been going on with data through this crisis, I've actually been really very impressed with how quickly many organisations responded to this crisis and the need for good data on what was going on. And I think that covers, I think the ONS responded very quickly in terms of things like the new business impact of COVID survey, as well as the ONS surveys obviously doing randomised testing to understand the spread of the virus itself across the country. But I think we've also seen a very quick response from researchers and research funders, including the Economic and Social Research Council, either funding the fielding of new surveys or repurposing existing surveys like the Decision Maker Panel and modules in Understanding Society to get very quick information on how COVID is impacting on the UK from a representative sample of businesses and households across the UK. And we've seen other charitable foundations like the Nuffield Foundation, Health Foundation, Resolution Foundation also coming in to quickly set up new surveys and get that sort of timely information that has really improved our understanding of this. Similarly, I think news outlets like the FT and others have done a very good job with the other sorts of big data that are available on things like internet searches, footfall, restaurant bookings. In some ways, I guess it's, so I know when I was at the FT, Chris and I spent many hours post the Brexit referendum trying to spot any kind of economic impact of that in those real-time data and singularly failing. I guess the thing that's been easier this time is the hit is so large. Any concerns you might have about sample selection, just you don't need to worry that you may get the magnitude a little bit wrong, but the fact that it's there in that very real-time data is kind of indisputable, and that, I guess, has made it a bit easier to use real-time data this time.
Okay, thank you, Gemma. Thank you for your contribution. So I'm going to pass now to Chris Giles.
Thank you very much, Anna, and thank you very much, Gemma. I'm going to violently agree with most of the things Gemma said. I have a slightly different perspective on the kind of real-time information, but not hugely. So just to go in sort of methodically through the questions that we were set. Is this recession different? Yes, it's massively different, both in terms of the speed of descent. To lose 25% of your economy between February and April is just unheard of. And we've been having great fun going back through the ESCoE's economic history data to work out when there was last a decline that quick or that magnitude. And I think we tend to agree that it's 300 years and the Great Frost of 1706, although some people disagree whether it's that or 1709. 25% is huge on any basis. And equally, the speed of recovery since April has been extremely fast, as the data you showed when you started this session, Anna, from the monthly GDP, showing that we've essentially recovered half of the losses already in the 3 months after April. So very, very sharply down, very sharply back up. And the cause is essentially the disease, of course, which is the ultimate cause for the lockdown. Governments would not have locked down economies, or people would not have voluntarily social distanced without the disease. It wasn't something that just happened, it was something that was a response to coronavirus. So in lots of ways, and I'm going to come back to this, the most important real-time data is real-time data on the disease, because that is ultimately the cause of what happens to the economy, and that is the data that is the most important thing we need to get a handle on. Is this a recession? Yes, it's clearly a recession. If you have a 20% fall in Q2 GDP, that is something we haven't experienced. The Great Recession of 2008, 2009 was a peak to trough decline, I think, of 8, or was it 6? I can't remember now. It does change a bit, but in that sort of, it's in the region of 2 to 3 times as large as a peak to trough fall we've had at any time recently. It happens to be that the first quarter was also a decline, so it does meet the 2 quarters of decline, consecutive quarters, if we want to go down that route. But certainly at the Financial Times, we definitively don't use 2 declining quarters as our definition of recession. We don't have a definition that we use. We decide that we have to use our judgment. And this time it's easy to use judgment, because 25% fall is really pretty unprecedented in any period in the last 100 years or so. We think it's about 300 years since we've had anything like this, so it's really quite an easy decision. So we are the real-time business in a news organization, so clearly we had to try and tell the story in real time, which was moving incredibly fast in March and in April, and that was primarily, we wanted to use real-time data on health. So we used a lot of the initial case numbers which were collated by Johns Hopkins University. That was extremely helpful. And then by all the other data providers around. But clearly that also had quite a lot of problems, and in the sort of rather grisly side of the death statistics were really rather out of date. And because testing was everywhere, a problem, then those numbers we found were pretty inaccurate. So we put a lot of effort into going around different statistical agencies to try and find excess death numbers, which I've got to say, the ONS was clearly one of the easiest to do. And it's because it had always produced weekly registrations of deaths, even though it was a little bit out of date, but only a little bit out of date compared with other statistical agencies. So the ONS, I think, deserves a lot of credit in that. So we were able to track in pretty much real time what was going on with the virus, and that then enabled us to look in real time at the economic consequences of the disease. Andy Haldane, Chief Economist at the Bank of England, has said that we're never going back to traditional economic data. He said that the real-time data used has significantly shifted the technological frontier when monitoring the economy. I'm not entirely so sure about that, I have to say. I think in this crisis and in this recession, absolutely, there's no question that he's right, and that real-time data has been the data that we've needed to look at, wherever it came from. And Gemma was absolutely right to say you need to look at the micro areas where the virus and the lockdown were most important to get a good sense of what was going on. But we do have to recognize there are problems with real-time information, and often because coverage is not perfect and it's not been necessarily looked at that carefully. So when we did this, and Gemma's also mentioned this, when me and Gemma tried to do this after the EU referendum in 2016, it was a spectacular failure to look at real-time data, partly maybe because human instinct means you look for things that have changed. And actually, as we now know from the real data, subsequently, that nothing really changed in the months after the EU referendum, except that the savings ratio fell rather than rose, which went in exactly the opposite direction to expected, and expenditure was in some sense higher rather than lower. And so you've got to be super careful about your choice of indicators. I mean, that's just something that's absolutely clear. And I think in normal times, where the movements are about 100 times smaller than the movements we've seen in the March to April period, we will not be looking at real-time data just because the selection problem and the scale problem will be so important. And we also have to note that some of the real-time data wasn't correct in this crisis in terms of the recovery. We know that recovery was significantly faster in May now than the real-time data at the time was saying. So I think it's been absolutely central this time round, but just have do be careful about saying that we're always going to be using this. I don't think we will be. I think you also need to look at the access and ownership of the data. Our experience at the FT in trying to collate this has been that the private sector has generally been rather better than elements of the public sector. And I'm going to leave the ONS as an honourable exception here. But lots of the public sector have very good real-time data. Highways Agency, they know how many cars are on the road. Would they let us publish it? No, absolutely not. But Google was able to do that really rather quickly. Open Table, again, was very good at looking at restaurant bookings. The DWP had to have their knuckles rapped multiple times from the Office of Statistical Regulation about just the way that they were putting out universal credit application statistics very early on in the crisis, and it was very hard to get them to do it in a reasonable and in a way that you knew when they were going to do it and at what time. So I think in lots of senses, the private sector has been very good. The ONS has been very good also with the business impact of the coronavirus survey and the use of HMRC data on payrolls. I think where we really are, and we're really back in it right now, is back at where I started. At the most important real-time data is the health data. And again, unfortunately, the case data is from the Department of Health still needs a lot of work. And in terms of their transparency, it's still problematic in that they keep deleting various data they put on their website yesterday and then overwriting it rather than leaving it as a record so that you can actually do sensible analysis. So I'll stop there. So it's a big recession. Real-time data has been important. It's not necessarily going to change the world forever.
Thank you, Chris. Now we're going to move on to Sumit.
Thank you very much, Anna. I'll come from the viewpoint of working in a National Stats Institute, but I'd have to say I share many of the same conclusions that both Gemma and Chris kind of highlighted there. As to whether this recession is different, the easy answer to that is yes. If you look over the last 100 years of UK history, each recession we've had has had its own kind of causes and consequences. So my own view is that every recession is unique in that sense. You can kind of range from financial crises to kind of management of it, fiscal and monetary policy to commodity price shocks. Each one is different, and that then manifests itself in terms of both the scale, the kind of the peak to trough fall, the speed of recovery. And as your slide showed, and as both Chris and Gemma highlighted, this has been unprecedented. You would have to go back 300 years to see anything near like a double-digit decline. But in terms of a kind of a perspective of the NSI, why is this recession more unique than others perhaps? It's I would argue, a rare instance where we're actually able to kind of pinpoint with some certainty as to the precise turning point. Normally we look through recessions, it's kind of a build-up, and there's lots of challenges of identifying turning points in real time, and I think that's the bane of many statisticians. Many are still scarred from the 2008 episode. But I think with this instance, it's quite clear as we went into lockdown, and the behaviours of households and businesses shortly before that and afterwards, it's clear when that recession took place. And a similar point on that is around data uncertainty, and again, that's another challenge for statisticians in able to convey what's going on in the economy, both not only in real time but with accuracy. We faced, and to a large extent fairly, I think, criticism around the 2008 episode around the double dip recession that never was. we're not clearly in that ballpark anymore. It's clear that it has been a recession, and you can see it with your own eyes. So I think that's probably another unique point that's worth bearing out. The two other points I'll quickly raise there. I think there's an element on the public understanding. If I don't quite know all the attendees at the ESCoE conference, but I imagine there's a lot of colleagues from other NSIs, policymakers, forecasters, research institutes, the media, think tanks, but it's very much that public perspective. That's, I think, is an interesting one. Friends and family of mine have taken an interest in what I do for the first time in many a year. And I think that looking to engage a lot more and try to communicate with the wider public, the intricacies of what's going on in the macroeconomy, I think is a really important one. And then a similar point to that was being a little bit more proactive in our response. This recession is quite unique in that it's actually led to measurement challenges for us and other NSIs in how we go about recording our core economic indicators. And one of the slides you showed earlier kind of highlighted the uncertainty and statistical fog around that. But I think what we've been able to do this time is be a little bit more proactive in kind of our handling around that and kind of being on the front foot and trying to explain to our key users, here are some of the challenges we face. Here's what we're doing in response to that. Here are some of the lessons learned from the financial crisis, first and foremost, I suppose. But here are some of the new innovative bits that we're looking to do, but recognizing that there is this statistical fog, I think, around some of our headline estimates. As to whether a large one-quarter fall should be considered a recession, very much the same view of both Chris and Gemma. I find it very kind of unhelpful, almost, the rule of thumb that is almost just taken as a given about 2 consecutive quarters. I suppose the way I kind of consider it is, had this lockdown period taken place 2 weeks later, so we're very much 1 calendar quarter, with the economy operating 20% below its pre-crisis trend, I find it strange that we would even have the debate around whether we were in a recession or not. Likewise, the argument that 2 consecutive quarters of a -0.1 and a -0.2 would be, strikes me as a very strange dynamic there, given what we know about the potential for data revisions. So I think the other points I'd raise there is you can also see it in a lot of our other indicators, both official estimates and some of the real-time ones, which I'll come on to in a moment. I think it's what probably warrants is a more nuanced conversation around what are recessions and what are not. And I appreciate, Chris made a point around judgments, and I think that is an important one. As an NSI, there is this challenge that there's obviously this convention in terms of the public understanding, rightfully or wrongfully, that a recession is simply at least 2 consecutive quarters. I think having the conversation is probably one that's worth having, and trying to educate and trying to just help inform that kind of conversation would be a worthwhile one. And I think the other point I would just say is just chiming the experience of households and businesses and government. It's very clear in the behavioural responses that we've all undertaken over the last 6 months that we are in a turning point. So I think just a strict rule of thumb is not particularly helpful in this context. It does open up the debate about how large does a larger one-quarter fall have to be to kind of go down that line. Clearly 20% is there, but is it 10%, is it 5%? And I think there may be conversations around there. But I do like Chris's argument around more about judgment. But I think there are some probably presentation challenges and communication challenges for NSIs around the world that probably need a little bit more consideration there. And then on real-time indicators, this has been obviously one of the key features, I suppose, in the kind of economic debate in recent weeks and months. And the experience of NSIs across the world is quite varied on this. There will be some NSIs who do produce kind of business and household surveys historically and look to produce composite indicators. In the UK, it's not something that we have looked at in the last 25 years or so, but clearly there has been a change to that. And I've been an advocate of that. I think if I go back to the Bean Review, which kind of led to the formation of ESCoE, one of the key recommendations there was about being a service provider for the ONS. And I think in terms of trying to meet that user need, this has been a key innovation. When I think of fast or real-time indicators, I think the 3 criteria that I come to are kind of timely, relevant, and accurate. Now, timely by definition will apply here. So I think the key interest for me is how relevant and how reliable are these indicators. I think they are really important, not only from the timeliness perspective, but also the higher frequency. I was quite pleased when we produced monthly estimates of GDP. That felt a big innovation, and now we're looking at almost daily kind of patterns. And I think that is really important in informing the path both in terms of the peak to trough fall, but also as we come out off that. In terms of, and so I should say that we've obviously responded this year in producing the business impact of coronavirus survey, but also a whole range of fast indicators in working with other kind of partner organisations, and I think that's been incredibly insightful. I mean, I would say that, of course, but I think from a policymaker perspective and a user perspective, to actually understand the response to business is a really important one. I think Gemma spoke about how heterogeneous this crisis has been in terms of the industries impacted. So I think the BIC survey there has been particularly insightful. As for the kind of the more traditional, I suppose, real-time indicators, I am an advocate, but I'd probably share similar caution to Chris. I kind of see these as complements to official estimates, but not substitutes. I think we're still quite a long way from that. I think there needs to be a lot more research in exploring the potential, but I'm convinced that there is a potential there. I think the things that we do need to understand is the relationships between the kind of selection of real-time indicators and how they track official estimates. It's, I imagine, quite easy for real-time indicators to pick up large 20% shocks, but that's not your typical recession. So how well do they perform over time? I think it's a really important question. I think it's also how relevant are some of these indicators. If I take things like the HMRC tax information and labour market or online vacancies, I can see those being actually very relevant indicators in most recessionary periods, and I think they can be particularly insightful as leading ones. But the ones on mobility, I'm less convinced by. I think the mobility indicators probably reflect the fact that we are in a lockdown. But also there's going to be structural changes to the economy. So even if you accept mobility indicators are a valuable one, the fact that there's been a move towards
Sumit,
online sales is probably one where that relationship will kind of break down over time. So those are my views on the three questions. Yes, the recession is different. I do believe large one-quarter falls should be considered as recessions. And I do think real-time indicators have the potential, but they're very much complements rather than substitutes.
Thank you for your views. Now Grant.
So I'm going to try and compress my thoughts into a couple of minutes, but I could probably talk at length around this. And just a reflection. So late last year, I was kind of thinking we're probably overdue a recession. As everyone said, every recession is different, and they all have different triggers. I did not expect it would be a pandemic that would trigger this, but I must say, reflecting on the state of the economy last year, labour productivity was weak, business investment was soft, and business expectations were not looking great. The share markets were looking quite toppy. It felt very late cycle. So I did think that either this year or next, we were probably likely to see a recession. I completely missed the pandemic as the cause of that, but you never know typically what's going to trigger the next business cycle downturn. And also thinking about this recession, I think part of the reason it's a bit hard for people to get their head around it is this is not a typical recession in that, as Sumit said, you haven't just seen a sort of a gradual softening of a range of indicators, whether it's labour market, industrial production, consumer confidence, etc. Effectively, we had this short, sharp shock policy-induced, and which we are now coming out of into what looks to me, looking at statistics, more like a normal recession, in that demand is subdued, unemployment is starting to pick up, sectors of business are still looking pretty weak, and of course, as employees start to come off the furlough scheme, most of those are returning to work, but some clearly will have lost their jobs, and we're starting to get some economic scarring coming through. And in some slides I'll show you in a minute, up to 1 in 10 businesses say that they are at severe or moderate risk of insolvency. So some further bad news to come over coming months, but it feels more like a normal recession now than it did back in April, which is probably a good thing. One or two other reflections in terms of the lessons you learned from each recession. I think one of the key lessons the ONS learned from the last recession, as Sumit pointed out, is quarterly GDP numbers, national accounts, are just too slow for policymakers to find useful in terms of the policy response. Hence, we introduced monthly GDP some years back. We're one of the few national statistical institutes to actually publish monthly GDP. I would hope after this downturn, more NSIs overseas will follow our example, because I think we found it extremely useful as a way of kind of tracking, not quite real time, but certainly at a much more immediate pace than quarterly national accounts will ever do. Just turning to real-time indicators, which I think is really a topic of interest. The other thing that we kind of learned is just not only the appetite in number 10 of the Cabinet Office and across government for faster indicators of what's going on, but the policy impact and uses that they would be made of in a way that simply wasn't possible back in 2008, because to be honest, a lot of the indicators we use, things like web scraping, Google Maps or Facebook data to try and identify where people are traveling, and those sort of daily or weekly indicators or credit card transactions or scanner data, they just weren't around by and large 12 years ago. They are now, and as Chris has said, there's a lot of data out there, some private sector, some from government departments and agencies. ONS has played a major role, I think, in trying to collate and interpret and use that to inform decisions made at the centre. In hindsight, I wish we had a few more of the real-time indicators up our sleeve at the start of the recession, but we certainly moved with pace to pull them together in any useful form to help inform decisions made by ministers. So just if I'm going to have an attempt to share my PowerPoint slides. Let me see if this works. Here we go. Can people tell me if they can see that slide?
Not yet.
Okay. Let's see if that actually works.
So there is a green, at least in my screen is green, so share a screen.
It's spinning, that's positive.
Ah, it's spinning.
If not, I'll just read off the slides. Anyway, while we're waiting for that to load, one of the lessons is that at the outset of a recession, you probably want to have a lot of those kind of weekly, daily, or certainly high frequency real-time indicators up your sleeve. We used to have a publication called Faster Indicators, which ironically was, no, it's not working. Anyway, I can send a link around to the slide deck and we can add it on the ESCoE website when this is posted online. We used to have a Faster Indicators publication was published monthly. One of the first things we did in the pandemic response was to change that to weekly and then to start to add lots of indicators. We also got a number of surveys up and running quite fast. The business impact survey is one. There's also a household survey, which was every 2 months, which we changed to a weekly survey, which was really useful in things like whether people are wearing face masks, how many people are self-isolating, etc. And of course, more recently, the COVID infection surveys, which we publish every week, we've got up and running and marshaled resources to those. So there's been an awful lot of activity at incredible pace, a lot of cooperation across government and with the devolved administrations in a way that I've never seen before. And certainly one of the lessons for the ONS from this, and I think for wider government, is that level of sharing of information and cooperation. I think we would want to continue after the pandemic and the recession over, because I think it's been a very positive development. In terms of faster indicators, the intention is to continue producing that as a weekly series and to add other data sources, public and private, to it. Chris, I share some of your frustration about not being necessarily able to access some of this data. I note that, for example, if you want the HR1 redundancy notifications, think tanks are obtaining that through FOI requests rather than being published readily available on their website. We have had a lot of discussions with DWP about the universal claims data, and I think that's exactly the sort of weekly information that ought to be in the public domain in a regular way. And I think increasingly you'll see the ONS become a platform, a cross-government platform for collating and publishing those kind of real-time management and administrative data sources. And we're certainly looking to grow that over time, because I think that is a genuine public good that ought to be readily and easily available to everyone for analysis. In terms of what kind of real-time indicators, it's less important, I think, to think about the sources than think about potential uses. And I agree with Sumit that certainly timely and relevant are really important, and that was our focus for the COVID response. Accurate, maybe not so much. In the slide decks that I was going to share, if you look at the big survey net balance of turnover and then plot that against monthly GDP, it's almost a perfect fit. So the good news there for anyone who hasn't created that chart and had a look at the correlation is we will likely to see further solid growth in monthly GDP in August. That's a useful leading indicator, but it's only useful for about the next 4 to 6 weeks out. Some of the other indicators also are quite good forward indicators, but you mentioned, one of the other speakers mentioned job vacancies. There are, of course, a number of job vacancy series out there. We publish at Zuna, but Indeed and Burn and Glass also produce high frequency data. They all tell us similar, but not exactly same story. And likewise with financial transaction data from card payment agencies, you generally get a very similar direction of travel, but not always the same kind of amplitudes. And in those areas, I think it's better to look at a range, add some interpretation and judgment.
Grant, I'm sorry, but if you could wrap up so we can open up for questions.
So I think that the key learning lesson for me from this recession is real-time indicators have a genuine place alongside our official statistics. Also in terms of business, the business impacts of COVID survey, we are likely to continue beyond the recession and the pandemic in some shape or form, because I think there will always be a need for timely evidence and analysis on what's going on in the business sector. And I guess look for more and better and more timely data from the ONS going forward.
Okay, that's great. I mean, it's great that a session that talks about recession, which is something a bit depressive, finish in a positive note. The fact that, you know, this led us to come with new sources of data, more timely sources of data, and relevant for economic decisions. So I'm really happy that we turned this in a positive, this panel. So I think what I'm going to do now is the following. There's some questions in here. There's one very interesting. Actually, they're very similar. So if the host could let Martin Will speak. He has a question about depressions and recessions.
I wanted to ask, and in some sense perhaps this is the same point that Chris and Gemma made, how useful the concept of recession is at the moment. Shouldn't we be talking about a depression, because the economy is likely to be depressed below its previous peak for some time to come, possibly a couple of years, whereas if we focus on the term recession, then assuming output goes on rising, even if only slowly, it's very difficult to say that the recession is continuing.
Gemma or Chris, do you want to answer that, or?
I'm very happy to answer that. I sympathise greatly with Martin's comment, but I disagree with it, because I think the word depression is very problematic in the sense that it has two meanings. One is the meaning that you just have given, that it's a level of output below the peak, and the other is, as in the Great Depression, which is seen to be a very bad recession. And those are quite different meanings. So I think what we're going to do at the FT is to concentrate exactly on what you say, Martin, and think about very hard about the level to which the economy remains below its previous peak, and report that number extensively, and just do it in numeric terms rather than giving it a name.
I see. Gemma, do you want to comment on, or?
No, I think I agree with Chris. I think for people in the general public, the term depression has a very negative connotation. I think it probably hides, I think it suggests a direction of travel, as in a lack of direction of travel back towards increasing output, that I don't think would be true, if you see what I mean. We could spend quite a long time with quite decent growth rates and still be in what Martin is determining the depression. But I don't think that's how the general public would interpret that word if you used it.
Okay, there is another question by Bart van Ark that I think, I guess, someone from the ONS could answer, because it's about management.
If you want to kick off, and then I'll just add some comments afterwards.
Bart?
Yeah, you can hear me?
Yes.
Yeah, so I'm just wondering about the reasons for the very large international differences in these output declines. So the UK has declined in the second quarter twice as much as some of the largest other European countries, which is huge. And also when you look at the annual forecast for the year as a whole, it looks like the US is only going to decline by about 4%, whereas most European countries will decline by 10%. Now, some of this may be related to just a different balancing of the health crisis and the economic crisis between those countries. But I wonder to what extent some of the panelists think there are some real measurement problems, and to what extent we should trust these very large differences as being real.
So thank you for that. So I think the 2 points you raised in your question yourself would have been my response. I think there is a point around the timing and the magnitude of the kind of policy response to that. So in terms of just how comparable the UK would be to other countries, I think those are the kind of considerations I'll be looking at. So almost look at this kind of the stringency of policy responses, the behavioural responses, and I think that would play a large factor in explaining why the UK impact was much larger. And as you say, it's that managing of that balance perhaps is the way to kind of consider that. I do think measurement challenges are something that needs further kind of work and investigation. I think I kind of spoke a little bit around some of the data uncertainty challenges. Clearly that wouldn't explain the kind of magnitude you're speaking about there, but I think what a lot of NSIs have kind of gone into is kind of facing some conceptual and practical challenges that have never been encountered before. I think the one that I've seen much more in the debate is around the measurement of non-market output and the extent to which in the UK, for example, if I take education as an example, we look at volume indicators then have made adjustments to account for the impact of school closures in not only the number of pupils in classes and in schools, but also making adjustments for remote learning. Now, I think there's much more debate in kind of international comparisons around how non-market outputs are recorded. If you look at our current price estimates, you wouldn't see as big a shock just because of the way we've gone about measuring education. Now, I think that potentially one avenue that might explain it, but there may be others, and I don't know if Mark has any further views, but those would be my two responses.
Thanks, Sumit. Just to add to that, you can't really look in Q2 in isolation because, of course, the public health interventions in the UK were later than France, Italy, and a number of other countries. It makes more sense to look at the first half, or Q1 and Q2, collectively in terms of the overall decline. We do treat public sector output differently. We have adjusted it in a way which most other national statistical institutes haven't. So actually non-market gross value added is probably a more consistent metric to take account of that. And when you do that, the UK over the first half of this year looks more on a par with France and lower than Spain, which is slightly different than the story you get if you look at the headline GDP numbers for the first half of the year. The other thing to be, I mean, there's probably other factors at work. One is that the UK has a larger service sector and smaller manufacturing sector. In some of those other OECD countries, you can compare them with, and you will have seen that unusually for this recession, services sector has taken a bigger hit than manufacturing. Normally it's the other way around. I suspect there's also some compositional differences such as that, which also explains some of the difference. But again, you could talk about this for quite some time. There's clearly a number of factors.
Okay, thank you for these answers. So let's move on. I now have a question by Seba Worku about accuracy.
Yes, thank you. My question is about compromising quality. Are we not worried about compromising quality by giving preference to relevance and timeliness over accuracy? I think Sumit mentioned it, and to some extent, and I think I wanted to hear your view.
Can I kick off? That's been a live debate in the ONS. If you like, probably unfairly dubbed, the old guard have basically said accuracy at all costs, and would have probably told the Prime Minister that if you wait 5 months, we'll have a fabulous quarterly GDP number for you. That doesn't work in real time. That's not what policymakers need. There is always a trade-off, obviously, between timeliness on the one hand and accuracy on the other. And unfortunately, or maybe it's fortunate, that the answer the ONS has come up with is to produce both the more timely real-time indicators and the official statistics, and accept that there will be a lag and there will be some revisions and some questions about the accuracy of some of those faster indicators that we produce. And we're quite open about that. If you look at our weekly faster indicators publication, there's lots of caveats and explanations when we do, and some of those numbers, the HMRC real-time payroll information, for example, that we published on Tuesday morning was heavily revised from the month before. We're quite upfront about that. If you want more accurate data, you can wait for the labour force survey numbers a month later. If you want to know, get an indication of where things are heading, you can use those real-time indicators. We provide both. We try and add interpretation and judgment as to how best to interpret those. And of course, some real-time indicators are more representative of what underlying economic trends than others, which are quite partial. So the thing that worries me the most about real-time indicators is just looking at the data is not enough. You need to add analysis, judgment, and interpretation to make sense of the story and to tell a coherent narrative.
Thank you, Grant. Now we have a different question in a different topic by Marianne Sensier. I think you need to unmute yourself.
I don't think she's able to unmute.
Okay, I've unmuted now. Sorry, my broadband suddenly fell over briefly. So how will the UK regions recover from this recession? And do the panelists think it's important to report on the geography of the recovery? Will this help or hinder with levelling up?
Gemma or Chris, any of you want to answer that?
I'm quite happy to give a quick answer. I think it's incredibly important, Marianne, and particularly at the moment where the geography of the economy is one of the central features of government policy. How a lot of the real-time indicators are actually quite good. They're quite geographically specific in that sense, but there are a lot of contradictory data out there at the moment, and so we've been rather careful not to give too much weight to the sort of very, very specific geographical data. One of the things that we have done very recently is look very carefully at the working from home phenomenon and what that means for the geography if that were to continue. And it's the upshot from talking to a lot of people and looking at the data was that really still very uncertain. Clearly, central London will be a loser out of all this. Whether London as a whole or the southeast will be a loser if London can attract more people to working in its economic zone because you don't need to live as close as you used to work in the London zone is a very live question. And that is one of the things that we clearly will be looking at as the recovery takes place.
Okay, thank you, Chris. Now we have a question by Paul Mizin.
I'd like to ask the question, how can we help economists to accurately describe the fall in output and the recovery without feeling the need to refer to letters of the alphabet?
Wait, what do you mean about that?
Well, is it a U shape? Is it a V shape? W shape?
The U shape and the V shape. Oh, they're brilliant visual interpretations of the data. Anyway, but I don't know if anybody else has views about V shapes, U shapes, and L shapes.
I'll dive in very, very quickly to say that I thought we got to the limit of alphabet when we started talking about the K shape.
It's a K shape?
It wasn't economic, but it was in terms of the market movements in this latest recession, which was, I thought, incredibly unhelpful. So I agree, Paul, these aren't very helpful. And I think the best way to do it is, again, to talk about this in numeric terms. How big was the drop? How much of the fall has been recovered? These are quite easy concepts to get across, I think, and that's the way I think we're going to try and do it.
I just want to make a comment on that. I think some of the issues with the shape of the recession is about the speed of recovery, right? So if it's a slow speed or is a fast speed. And this is something, I guess, then we're not talking about measurement anymore. We're almost talking about forecasting. But it's something that you'll be more uncertain about it, whether how fast it will be. Yeah, but of course, it's much better to give an understanding on the depth of it without the letters. Okay, so I think this was the last question from the audience. I don't know if you guys want to say any final thoughts. Grant, do you want to say anything else?
Well, I did a little spiel earlier. Look, the one caution I'd make, and going back to Paul Marsden's comments, is look, We're only 6 months into this recession. Recessions typically last 18 months, 2 years, 3 years. Who knows what the shape of the economy will pan out over the next 6 to 12 months. You know, clearly we're heading into winter. There's a lot of talk about another upsurge, potentially further lockdowns. And of course, we also have Brexit to look forward to as we end the transition period at the end of the year. So there's all sorts of potential economic shocks over the next 6 to 12 months to look forward to. And I think it's impossible in terms of where we are now to really know how that will pan out, to be honest.
And it might be that it's going to be much harder to figure out when the recession ends than when the recession starts. So we always start this debate saying that this time was not that hard. We use our judgment, but wasn't too hard. But it might be that to get the top at the end of the recession would be much harder than usual.
Yeah.
Okay, so thank you for all the panelists. I think it was a great discussion. I hope the audience enjoyed this session. And you know, I hope to see you all again in some of the other sessions of this ESCoE conference. I guess we have loads of parallel sessions in this afternoon. We probably have issues on measures of GDP and COVID impacts as well. Okay, so bye-bye to everyone.
Thank you, Anna.